Welcome to this explainer. Today, we're diving into a genuinely startling financial theory from our source material. We're looking at a massive, impending shift in global markets, one that challenges the very foundation of how the world's most enduring asset is valued. Okay, let's jump right in.
July 24th, 2026. You might want to circle that date on your calendar. According to the deep dive analysis in our source documents, this specific date marks a quiet yet absolutely monumental shift in the global financial system. On this day, major Chinese banks are officially slated to halt paper gold trading for their everyday retail customers. It sounds like a simple administrative change, right? While the implications outlined in the data are actually staggering.
And we aren't just talking about a few small regional branches here. This shift includes the Industrial and Commercial Bank of China, which is literally the largest bank on Earth, alongside the Postal Savings Bank and Ping An Bank. Now, the official reason provided by these massive institutions is highly practical. They claim it's a move to protect ordinary people from wild price swings in the precious metals market. But our source suggests we really need to look a lot deeper than that.
Which brings us to the explosive central premise we're unpacking today. Is the daily price of gold actually fake? The source documents argue that the price ticker you see blinking on your financial news screen is nothing more than an illusion. Instead of representing true value, the analysis points to a calculated geopolitical master plan currently underway to completely shatter that illusion and reveal what physical gold is genuinely worth.
Section 1. The 1968 precedent and the London gold pool collapse.
To understand where we're going, we really need to look at where we've been. Following World War II, the US famously backed the dollar with gold, fixing it at exactly $35 an ounce. But moving into the 1960s, the US began printing excess dollars to fund significant overseas wars and domestic spending. Well, foreign governments quickly did the math, right? More dollars were chasing the exact same amount of gold. So they started demanding the actual physical metal instead of paper dollars. To hide this inflation, 8 central banks got together and formed the London Gold Pool to artificially suppress the price and keep it pegged at $35.
The source material puts it incredibly bluntly. In a single week in March 1968, they lost 1,000 tons of gold, suppressing the price. The market broke. Just think about that for a second. 1,000 tons in just 1 week. This artificial suppression worked wonderfully on paper, until it catastrophically failed in reality. Get this. The floor of a weighing room in the Bank of England literally collapsed under the sheer weight of the metal they were moving. It proved, once and for all, that physical realities eventually and forcefully overpower paper manipulations.
Section 2. The paper illusion in modern gold markets. Fast forward to today, and the entire theory hinges on one deeply alarming ratio: 10 paper claims for every 1 physical ounce. The analysis claims that right now we are sitting in the exact same precarious setup as the 1960s. Today, when modern investors buy gold, they almost never take home actual metal, right? They just buy a paper contract. Because so few people actually ask for physical delivery, financial institutions can sell up to 10 times more paper claims than there are actual physical gold bars sitting in their vaults. It's kind of like a giant game of musical chairs.
So what exactly does this setup create? Well, it creates what's called artificial supply. When paper contracts vastly outnumber the physical assets, the market perceives this massive abundance of gold that frankly doesn't actually exist. This directly suppresses the true market price. The source emphatically argues that the world's most important financial asset is currently being priced by a market that completely lacks the ability to verify its own physical holdings.
Section 3. Following the smart money and central bank maneuvers.
If you want proof of this impending global shift, the source advises us to completely ignore what big institutions say to the press and strictly investigate what they're doing on their balance sheets. The data shows central banks just made their strongest first-quarter gold purchases in recorded history. Plus, insiders estimate there's massive, unreported buying occurring in the shadows. And how exactly are they funding this quiet hoarding of physical metal? By aggressively selling off US treasuries.
Which leads us to a truly incredible macroeconomic milestone. Gold has officially flipped US bonds as the largest reserve asset for global central banks. This isn't just some minor data point, this is a massive clue. The source points to this as clear, undeniable evidence that global powers are actively preparing for a new system. A system where tangible physical assets vastly outweigh paper promises and debt.
Section 4. The Wallet Connect and how this impacts you.
Now you might be wondering, how does this actually affect me? The real-world consequences are staggering. Let's do a quick comparison. In 1976, the average US house cost about $44,000. Today, that same average house is going to run you around $425,000. We've all been taught to just call that inflation, right? But actually, wait, look at it priced in gold. That 1976 house cost 335 ounces of gold. Today, it costs less than 110 ounces. When measured in physical metal, housing didn't get more expensive, it actually got significantly cheaper.
This brings us to a stark, incredibly powerful quote from the analysis. Everything actually got cheaper. The dollar just died. Whether you're looking at your grocery bill, gas, or housing, the underlying assets haven't intrinsically changed in value. What this quote highlights is that the paper currency we use to measure these assets has simply lost its purchasing power.
But here's the kicker, the absolute most shocking part of this whole breadcrumb trail. These numbers are based on the suppressed paper price. This severe structural loss of the dollar's purchasing power is happening right now, even while gold's price is allegedly being artificially held down by those 10-to-1 paper contracts we talked about earlier. If the physical price breaks free, gold's true purchasing power and the corresponding weakness of the dollar would be significantly more pronounced.
Section 5. The Master Plan and China's Strategy for Price Discovery. So how exactly does this system break? The source material outlines a deliberate, calculated three-part strategy orchestrated by China to break the paper illusion once and for all. Step 1. The Shanghai Gold Exchange mandates actual physical delivery. You can't just trade paper claims anymore. The real metal must physically move from vault to vault, forcing true price discovery. Step 2. China uses Hong Kong as the international gateway, routing global capital there to trade at Shanghai's unmanipulated physical price. And Step 3. Hong Kong massively expands its infrastructure, growing its vault space by 10 times to store over 2,000 tons of actual metal.
The logic here is just beautifully simple. You don't build massive physical vaults for paper contracts. You just don't. The source argues that spending the capital to expand vault space by 10 times is the ultimate, undeniable proof that the East is actively preparing for an unprecedented influx of actual physical gold. They're building the infrastructure for a physical reality, not a paper illusion.
Let's bring this full circle back to history. In 1968, the London gold pool collapsed entirely by accident under the sheer weight of market forces. But as we approach that target date of 2026, this theory suggests the dismantling of the paper market is happening entirely on purpose. It's a structured, intentional unwinding of the global pricing mechanism. Which leaves us with one final, deeply provocative question. What actually happens when paper markets shut down and the ultimate currency's true price is revealed? If this theory holds true, we're looking at a radical transformation of the global economy. It forces us to ask ourselves just how prepared we are for a world where financial illusions vanish and only physical realities dictate value. Thanks so much for joining me for this explainer. Keep asking questions, and I'll catch you next time.